Hey everyone, and welcome to Project Premium Harvest. My name is Matt. In today's video, I'm going to be talking about NVDY, or as some would like to call it, NVDY. This is a high income ETF from yieldmax that produces a premium distribution every single month by selling and writing calls on NVIDIA itself. The main thing I'm going to try to achieve in this video is, can we retire off of investing into NVIDIA either in a tax advantage retirement account, or if we can't meet that requirement, can we at least enhance our life by receiving a premium every single month? What is that going to look like? I'm going to look at a couple different factors. I'm going to look at if you invested in this fund at inception. A lot of you guys are going to hate me for bringing that one up because, yes, I understand not many people actually bought this fund at inception. But we're also going to talk about if you invested in the absolute worst part, when this stock hit its highest point ever. And I'm also going to talk about the investment I made into this fund. I have been invested into this fund since this YouTube channel has started back in June 2024. However, I greatly reduced my investment into this fund. So now I have about a $33,000 investment I bought back in December, and that's the numbers I'm going to use. And then with that being said, we're definitely going to have to talk about return of capital because these funds use return of capital for some tax advantage purposes, but I'm going to break down how that actually looks like. Because some of my other videos, I didn't go further enough. I kind of gave a generic of the amount of taxes you're going to have to pay outside of the rock, but then I didn't explain the cost basis part of the taxes for return of capital. So I'm going to discuss that. And we're going to go from there. Let's get going. As you guys can see here, the current share price of NVIDIA is that $17.54. When I made this video, it was about $17.49. So the share price that we're going to compare against is going to be that current price of that $17.49. Now let's take a look at the inception price. For the inception price, I did a flat $20 to make everything simple. Now let's talk about if you invested into the absolutely worst part, or the highest point of this fund. Let's look at that. It's going to be that $30.51. And then for my NVIDIA shares, I have a cost basis of, let's see here, $22.59. So I'm going to use those three different metrics for some of the data collection. And let's go over the spreadsheet. All right, guys, now that we are at the Excel spreadsheet, let's kind of dive into the numbers of what we're looking at here. So I have three different pillars of information. The first pillar, I'm going to be calling it NVIDIA total, and that's going to be if you invested into NVIDIA at inception, so at that $20 price. NVIDIA peak is if you invested into this fund at its highest point ever, and as we saw in the Robinhood, that was going to be that $30.51 mark. And lastly, the NVIDIA Matt, that's me, Matt. We talked about it. My cost basis was $22.59, and we're going to discuss what potential returns could look like by investing in December, right when that bear market started. So let's start talking about the numbers. So for all of this information that I compiled, I pulled this from the yieldmax site, and let me go over to show you where I got it. And if you guys can see my screen here, if you scroll down, we see distribution details on the screen, and I just copied all of this information, pasted it into my spreadsheet, and then made it look nice and pretty for you guys to digest. So let's go back. If we invested into NVIDIA at the inception, guys, I understand not many people have invested into this fund at inception. That is going to be about 22 different payments. I use months, but it's payments. And so if we look at the total amount of premium paid of owning NVIDIA, you received about $27.91 of distributions. If we were to break that down per payment basis, like per month, per payment basis, that's going to be a 1.26 distribution per payment. And if we estimate that over a yearly period, that's going to be about $16.49. And if you look at that as a distribution rate, that's 82.49%. All right, now let's talk about NAV erosion or NAV appreciation. Because we bought the share price theoretically at that $20, and the current share price, as what we mentioned, was that $17.49, we have a NAV erosion of about $2.51 of owning these shares. And if we look at that as a percentage, it's about a negative 12.55%. And it is what it is. Speaking of return of capital, this is some information that you have to pull from the yieldmax site. So I'm going to go back to the yieldmax site and show you where to find that information. Okay, back at the NVDY main page here, we're going to scroll down to supplemental tax information. Over here, click on this beautiful button, supplemental tax. And the way yieldmax does their tax documentation is now they're doing it by group. So NVDY is in group B. So I'm going to go over there, and the most recent group B 19A1, which is the return of capital document, is January 31st of 2025. So I'm going to click on it. And let me zoom in a tad. And let's find NVDY. We have Meta, and now we have NVIDIA. So this is what we're looking for. The NVIDIA Options Income Strategy ETF. Net investment income is 6.34%, but the estimated return of capital is at 93.66%. So this is where we find that specific information. Cool, now let's go back to the spreadsheet. Okay, now that we annotated ROC as 93.66%, the net investment remainder of ROC is 6.34%. Basically, this means that of the distributions we have gotten from NVIDIA, 93.66% is return of capital, which we don't get taxed on. We get taxed on the remainder of that, which is 6.34%. And then there's another point to that in reference to cost basis. But once we go to some of the charts with actual investment numbers, it will make more sense when I explain it there. But since inception, if we take out NAV erosion, the actual net is about a 25.41 distribution for 22 different payments. And if we look at that over a payment per monthly basis, that's 1.15. And since inception distribution rate, that's 127.04%. So pretty good. Now let's talk about if we invested at the absolute worst point in time of NVIDIA. We look at that, that's going to be at that $30.51 share price. And the way I calculated this is whenever that share price spike happened, that was February of 2024, I compiled every single one of those distributions, and then we did the math that way. The current share price is still going to be that $17.49. And if we look at that per month or per payment basis, we have 14 payments since that highest point that share price crested. So for that total premium, it's about 22.2464. And if we look at that over a monthly yield or per payment yield, that's 1.5890. And if you look at that over a redistributed yearly period, that is 20.6574 total distribution. And compiling that as an average, that's 67.7069% distribution rate. So that's kind of good. Now let's look at the NAV erosion for that high period. From that $30.51 down to that $17.49, we have lost $13.02 in share price. So the price NAV eroded. And how much did it NAV erode by? 42.67%. Going back to return of capital, this number is going to stay exactly the same. And once we subtract this $13.02 from the total distribution, we are left over with 9.23. And if we look at that as a per payment monthly yield, that's about 66 cents per share. And then if we look at that as a distribution rate, that's 30.24%. And let me explain why I like to calculate NAV erosion by removing some of the distribution price, because the way these funds work is they pull money from the share price to pay you back. So the only way, if you were to retire on this number, is you have to put $13.02 back into the investment so you wouldn't lose money. Of course, you don't necessarily have to do that, but if we're just trying to stay true to this scenario, you would have to put that $13.02 back into your investment. Otherwise, you have lost that money. You don't have to put it in. You can take that money and put it into a different investment that isn't as volatile. However, to keep the numbers a lot simple and streamlined and to make a determination, can you live off of it? This is what we're going to have to do. And let's go over where I currently bought at. So share price again is at $22.59. Since December, that's only 3 payments. The share price is still at $17.49. For the 3 months of payments or 3 payments, it's 3.3395 distribution per share. Over a monthly yield, we look at that as a yield, it's 1.113. And if you look at that over a year period, that's 14.4711. And if you look at that as a distribution rate, that's 64.06%. Now let's go over to NAV erosion. Since I bought this right at the start of a bear market, I've already lost $5.10 of that share price. And if you look at that as a percentage, I've lost 22.58%. NAV or return of capital is still the same number, and the net investment is what we're going to have to pay capital gains taxes on, 6.34%, still the same. But the way I calculated the total net premium is I took this $5.10 and subtracted it by the estimated distributions for this fund, so that $14.47. And so we came out with $9.37. We look at that from a per payment per monthly basis. That's about 72 cents a share per month per payment. And then distribution rate's 41.48%. Now that we got most of the baseline information down, let's scroll over to the actual charts and start diving into these numbers. Let me scroll out a little bit more, one more, boom. Okay, this first chart that I'm going to discuss is if we invested into NVDY at inception. Guys, I know no one has really invested at inception, but just for the data's sake, we're going to talk about it. Purchase price is still going to be that $20. Premium yield is 127.04%. The net premium monthly average or payment, I should probably change that, is 1.15, and the net yearly is $25.41 per share. And then the tax distribution at ordinary income is, let me scroll over to the right, it's still that 6.34%. So let's dive into the numbers. All right, so imagine if we had a $1,000 investment, $10,000, $25,000, $50,000, $100,000, or $1 million investment into NVDY. These are what the numbers are going to look like. For a $1,000 investment, we're going to own 50 shares, and that monthly income of owning NVDY is going to be about $57.75. And if we look at that as a yearly income, that's $1,270.43. So now let's talk about return of capital now that we have some concrete numbers to look off of. Because NVDY is a 93.66% return of capital, we still have to pay capital gains or ordinary income on that 6.34%. So that 6.34% of $1,270.43 is $80.55. And if we look at that as a tax rate or a tax number, you only have to pay taxes on $8.05 of that distribution. Okay. But now let's go a little bit further. This is one of the parts where I didn't do a good job of in my other video, so I want to definitely highlight that here. So total taxes is still that $8.05. Net after taxes is $1,262.38. So that tax rate is about 0.638%. But now let's talk about the cost basis. And because of this distribution or this premium yield being so high, it's over 100%. We're going to hit our cost basis in that year time frame. So our cost basis is about $1,000. That's our investment. Okay. And because this fund has went up to $1,270.43, we are over our initial cost basis, $270.43. And the way this works is, since this is over our initial cost basis, this is going to get taxed at capital gains rates. So let me explain this as clear as I can. If we have gotten to this $1,270.43 less than a year, this $270.43 is going to get taxed at capital or short-term capital income levels, and that's ordinary income, which is like the normal tax brackets. If this $270.43 is over a year, we've held this for over a year, and then it finally got the cost basis over a year, then we only have to pay long-term capital gains on this $270. And because this $270 is less than $44,625, or if you're married, $89,250, we pay 0% tax on this. And this is going to make more sense as we go further down the line. But for a $10,000 investment into NVDY, we're going to own about 500 shares. The monthly income of a $10,000 investment is $577.47. The yearly income comes out to $12,704.30. Because of return of capital considerations and only paying 6.34%, we only have to pay taxes on $805.45. And then in a 10% tax bracket, because it's 805 falls in that 10% marker, we only have to pay taxes on $80.55. But now we have to go look at the cost basis. Because our initial cost basis was $10,000, this $2,704.30, that's above our cost basis. So technically our cost basis, once we hit $10,000, is zero. Because we're $2,704.30 over, we have to pay capital gains on this $2,704.30. So since if it's less than a year, it's at short term. If it's over a year, long-term capital gains. So now that we kind of have that, baseline down, I might go a little faster of explaining these numbers. For a $25,000 investment into NVDY, that's 1,250 shares with a monthly income of $1,443.67 and a yearly income of $31,760.75. Because of the return of capital considerations, we only have to pay taxes on $2,013.63 because that is in the 10% tax bracket. We only have to pay taxes on $201.36. But moving over to our cost basis, our initial investment was $25,000. We are at $31,760.75. That is above our initial cost basis. So we have to pay capital gains on the $6,760.75. Since we'll just, for the sake of this video, we're just going to call it long-term because it's over, we're going to say a year or more. And $6,760.75 is below that $44,000 mark. We pay 0% taxes. Okay, moving on to a $50,000 investment into NVDY. We are going to own 2,500 shares, monthly income $2,887.34, yearly income of $63,521.50. Because of return of capital considerations, we only have to pay taxes on $4,027.26. Because that falls in line with that 10% tax bracket, we only have to pay $402.73 in taxes. And because our initial investment was $50,000, we had more distributions paid out than our cost basis. So now we have to pay anything above that $50,000 capital gains on that $13,521.50. Moving on to the bigger, more fun investments. For a $100,000 investment into NVDY, we're going to own 5,000 shares. Owning 5,000 shares is going to give you a monthly premium of $5,774.68. That's a yearly income of $127,043. Because of return of capital considerations, we only have to pay 6.34% of that $127,000, which gives us a number of $8,054.53. Since this $8,000 is still lower than that $11,000 threshold, and that still puts us at that 10% tax bracket, we only have to pay taxes on $805.45 of that distribution. But because $127,043 is above our initial cost basis, we have to pay capital gains taxes on that $27,043. Cool. Lastly, $1 million investment. We're going to own 50,000 shares of NVDY. Monthly income, this is crazy, it's $57,746.82. Yearly income of $1,270,430. Because of the return of capital considerations, we want to pay 6.34% of that $1,270,000, which gives us a number of $80,545.26. Because this hits a couple of different tax brackets, we're going to have to pay about $13,027.46 of ordinary income for the distributions. But because $1,270,430 is above our $1 million cost basis, we have to pay capital gains on $270,430 of that net. Cool. So that kind of explains how that works. Now let's move over to see what the numbers would look like at NVIDIA at its peak. So it's going to be relatively the same setup, but the only thing that changes is the price purchase. So for a $1,000 investment, we're going to have 32 shares and a monthly income of $21.60. Let me also go over the premium yield. The premium yield is going to be 30.24%. Net monthly average or per payment is going to be 66 cents, and the net yearly is going to be $9.22. The net tax distribution at ordinary income is still 6.34%. All right, but going back to that $1,000 investment, now for the yearly, that's going to give us a $302.41 yearly income. Because of the return of capital considerations at that 6.34%, we want to pay taxes on $19.17, and it's in a 10% tax bracket. So that's only $1.92 in taxes. But we need to go a little further, because since this premium yield is not like 100%, it's 30%, we have to talk about the cost basis. Because our initial cost basis was that $1,000 and the yearly income was $302.41, our cost basis still hasn't hit zero yet. So our new cost basis isn't $1,000. It is now $697.59. So we theoretically, if everything stayed the same, distribution stayed the same, the investment stayed the same, you didn't buy any more shares, then the next year, year two, over a year period, you get another $302.41. This would lower the cost basis down to that like $395 mark. And then so you could basically ride this out for about 3 or 4 years before your cost basis meet that $1,000 threshold. And then, like I said earlier, anything once it hits that $0 threshold, that $0 cost basis, is going to get taxed at this now long-term capital gains. Right, so it's less than that $44,625, 0%. Anything from $44,626 and up, 15%. Anything over that $492,000 is going to be at 20%. Okay, so now that we have that cost basis information down, let's continue forward. For a $10,000 investment, we're going to own 327 shares of NVIDIA. The monthly income is going to be $216. Yearly income, $3,024.06. Because of return of capital considerations, we're at that $191.73. Since it's in the 10% tax bracket, we only have to pay $19.17 in taxes. And then let's go over the cost basis again. Because $3,000 is less than $10,000, we haven't met our cost basis. So we don't have to pay any additional capital gains, either short-term or long-term. And our new cost basis is not $10,000. It is now $6,975.94. Okay, for a $25,000 investment into NVIDIA, we have 819 shares. That's a monthly income of $540 and a yearly income of $7,560.14. Because of return of capital considerations, we only pay taxes on $479.31, and that is in a 10% tax bracket. So $47.93 of taxes. Because this $7,560.14 isn't more than that $25,000, we don't have to pay any additional taxes because it's not at our cost basis yet. But this carries over until next year. So the new cost basis for next year is going to be that $17,439.86. And we're going to continue moving forward. For a $50,000 investment into NVDY, we're going to own 1,639 shares. Kind of where I'm at with about 1,500 shares. It's a monthly income of about $1,080.02, a yearly income of $15,120.29. Because of return of capital considerations, we only have to pay taxes on $958.63, and it's in a 10% tax bracket, so it's $95.86 of taxes. For the cost basis, that $15,000 did not cross that threshold. That $15,120.29 did not beat that $50,000 threshold. Therefore, we don't have to pay any additional capital gains taxes on the distributions we receive, just that 6.34% ordinary income. But our cost basis is now reduced to $34,879.71. And we're basically going to carry this forward until the next year. Once we get more distributions next year, it's going to also bring this cost basis down. Once it's at zero, then we go to long-term capital gains. Okay, now for a $100,000 investment into NVDY, we're going to own 3,278 shares, which is a monthly income of $2,160.04. It's a yearly income of $30,240.58. That, with return of capital considerations at that 6.34%, we don't have to pay taxes on $1,917.25. It's that $1,917.25 is in a 10% tax bracket. So we only have to pay $191.73 in taxes. But let's look at the cost basis. And so since that $30,240.58 is not near our cost basis, we subtract that number, and our new cost basis is $69,759.42, and that gets moved over till next year. And lastly, for that $1 million investment, we're going to have 32,776 shares, monthly income of $21,600.41, yearly income of $302,405.77. Because this $19,172.53 hits two different tax brackets, we have to add these two numbers up, and the total tax for that $19,000 is $2,080.70. And going over to cost basis, our cost basis was $1 million. We only made $302,405. So basically, we take this $302,000, subtract it from that $1 million, and our new cost basis that's going to carry over until the next year, until we sell these shares, is $697,594.23. And then for my numbers, they weren't too far off from the ones previous, so I don't want to waste anyone's time moving forward and talking about those numbers. So we're just going to bypass that, and I'm going to give you some of my closing thoughts about investing into NVDY. All right, guys, here are my final thoughts for investing into NVDY and this specific video. Can you retire off of investing into this high income ETF from yieldmax? I think you can. However, I wouldn't actually invest all of my money into this one fund. I would spread out the risk, and I would put maybe like 10% of my portfolio into something this volatile. I wouldn't do anything more, because when the going is good, these high income ETFs are great, but at a like chop market where the fund isn't going up, or if it's going down, for every 1% that the stock market goes down, like the S&P 500, these yieldmax funds will go down 3 to 4% more for that 1%. So it's just something to think about. Also, it does play a role having this investment into a tax advantage account like a 401k, Roth IRA, so that you don't have to pay the tax burdens once your cost basis gets zero. And if you sell in and out of these funds, you're not going to get penalized for it. For me, I used to buy NVDY at the ex-dividend and then sell whenever there's a pop. However, I didn't realize that because I did this, my cost basis was lower, so that when I sold out, it showed that I was making a lot more money than I actually was. And during tax time, I did have to pay quite a bit more than I was anticipating. However, whenever I do my taxes, I like to blanket eyeball the number, so I had the money set aside. But for someone that isn't as prepared or is not familiar with these funds, that's something to be worried about. I don't recommend buying in and out of these funds, especially if you're holding them through a distribution period. If you buy and sell them before a distribution happens, I don't think that's necessarily a problem. But if you hold the fund, get a distribution, it lowers your cost basis, then you sell out. You know, choose your own adventure. However, I don't think the juice is worth the squeeze. If you invest in these funds, holding them long term is a solution. However, they are very volatile, so it's very difficult for you to sleep at night if you're highly invested into these funds and if you're using margin. So just balance out your risk is all I'm saying. Could this be a nice side income stream? I think so. I'm currently using my NVDY shares to pay back the HELOC loan I took out against a rental property I own. I paid off almost half of my HELOC loan. I think I'm at $45,000 left out of the $83,000 I pulled out. So it's slowly but surely paying off that loan. And then once I pay off the HELOC loan, now I am getting that distribution and I can hold it as cash. But yeah, guys, that pretty much wraps up the video. Let me know in the comment section if what I was explaining with the cost basis makes sense, or if I need to go into more detail about it. But yeah, guys, hope you enjoyed the video. I'll see you next time. Matt out.